Hi, and welcome to your weekly macro roundup. We talk macro and try to make sense of markets that only make sense on days that bond prices are up. I'm your host, Steve Van Metre. Today's episode is appropriately titled, Banks Just Trolled the Bond Market. Told you they were probably doing something like this. And wait till you see the data is crystal clear. Before we get into all that, I do want to thank all of you for your feedback on the, was it yesterday's? Yeah, the Wednesday explainer video on Jeff Snyder's research, which was kind of dovetailing our Monday video. And the feedback you gave me was great. So here's a plan. We'll do some more explainer videos. The next one will be on Dr. Lacey Hunt's third quarter report that just released. I don't know if, well, the markets close on Monday. I don't know if I'll come in and just do that as a video, or we'll just, make it sometime in the weeks to come. I don't want this to be where, hey, or can you explain this? And we're using it as an attack video to say, so-and-so is wrong. I want to use this as finding experts that actually know what they're talking about, and we're trying to understand what they mean so we can become better investors and ultimately support long-term investing thesis. That's the goal. So we'll do more of that. Also, I took a little walk around the world with our friend Martin Northend. I'll link to this in the description below if you haven't already seen it and want to check that out. Martin is a big fan of the show. Of course, we're a big fan of him and his show as well. Thanks for watching, Martin. We appreciate you very much. All right, so on to what's going on in the markets today. Oh, and you know what? Because the banks trolled the bond market, yeah, you know it. We got to go back to the crown. I know I didn't wear it the other day. Just, wanted to test your patience. But when the kingdom is under siege, sometimes what appears to be under siege is the kingdom just luring them into our trap. Pretty brutal. All right, let's talk stimulus, because the markets are hopped up on stimulus. We saw the bond market sold off a little bit and then rallied back midday to close flat on stimulus hope. So what's the truth about what's really going on in the stimulus world? Is it takes about 2 weeks to get a bill passed. And there's going to be nothing after the end of October. I mean, there's Congress, and all this is not going to be trying to pass a bill the week of the election. That's not going to happen. So effectively, we've got 1 week left, because under the best of circumstances, assuming that a bill is drafted, agreed upon, the House has the votes, the Senate has the votes, a president wants to sign off on it, you still got 2 weeks. Obviously, there's still no consensus that even if there was a bill that everyone could agree on it, meaning we have 1 week left before there's no stimulus bill before the election. Now, this is going to get interpreted as, okay, no big deal. As soon as the election's over, there'll be a stimulus bill. Key parts of that's going to be as soon as the election's over, because it's not going to be over on election night. We already know that. There's too many mail-in ballots. It's going to take, a month. I'd have to ask my wife. She's the expert. She handles all the politics in our household. She's the expert. I'm guessing a month to count all the votes. And even then, the election is likely to be contested. There's going to be lawsuits filed. And the problem then becomes there won't be a stimulus bill until there is the definite knowledge of who's going to be president. That's the problem. Now, what does that mean from the consumer's perspective? Because there's a lot of people that do need stimulus. They're short on money. They're running out of money. But think about this. Back in May, the economy shut down, and a lot of people started putting their loans in deferment starting in May, June, July. And then coming into August, September, the economy started to reopen and recover. So what does that mean? It means this month, in October, we're starting to see loans coming out of deferment. What are we going to see in November? More loans coming out of deferment. What are we going to see in December? Even probably the last of the loans coming out of deferment, except for potentially the government insured mortgages, where they can be extended up to 12 months and the payments can go to the end. And some of you have emailed me and said, hey, Steve, I'm really concerned because I've got these loans coming out of deferment later this year, and it's going to be a problem. And if there's no stimulus bill in the next week to be passed at the end of the month, if you think the worst is behind us, get ready. Because when people can't make those payments and there's no stimulus because there's no certainty of who's president, and if you don't understand how this is going to play out, is Congress, they're always worried about their own reelection, and they don't want to go support the person who's not going to win. So if they go out and put support for either Biden or Trump, and it turns out that person actually is not going to be the president, it's not going to look good for them. So you're going to get this whole period where things, maybe there'll be an emergency bill of some sort, but don't expect anything big. So the markets are hopped up on this, but that is going to fade out probably around this time next week because the clock is ticking. All right, let's go into the economic data. I was given a suggestion by a phenomenal entrepreneur that I had the great pleasure of talking to this week. If he's listening, I really enjoyed our call. The guy is just absolutely brilliant. And he said, Steve, when you go through the economic data, I can read it too. Why don't you tell me what you actually think of it? Good point. So let's just dig through some of the U.S. data this week before we get into the massive bond trolling that the commercial banks were doing. Let's move into, and we'll just stick with the U.S. data. So we did go over the market composite PMI and the ISM, and I think the market data is a little bit better. I'm mostly focusing on the services for the market. I didn't mean the composite PMI, but this week we saw the services sector. Now, what does this tell me? It tells me that the services sector is not in a V-shaped recovery. It's slowing down. So if I'm looking for inflation, or if I'm looking for a massively recovering economy, or if I'm looking for something that says my thesis is wrong, I'm not seeing it in the services sector. I'm seeing it slow down, because when we dug into this, and I really wish the charts would pull up, and of course it's probably not, it shows me the services sector is slowing down. Now, looking here, we see this thing was flat in July and just finally getting into expansion after it was flat after that big crater in May. It just said virtually no growth, and now it's just starting to crawl its way from the bottom of the hole up. So it's telling us that the services sector is in trouble. And we know that there's no inflation coming out of that, no economic growth. So that is something that I'm looking at. How about South Korea CPI year over year at 1%, increase from 0.7? What does that tell me? Well, that will affect import prices potentially a little bit. So there's maybe a smidge of inflation potentially coming out of South Korea. We'll see how that looks when we do get more data. How about the import and export data that came out on Tuesday? And this tells me that import growth and export growth are slowing. The export growth is slowing more. So imports is slow down almost as we're looking at a recovery of inventories, but exports are slowing. And when exports are slowing, it tells you the whole economy is slowing. So the export data is validating what I'm seeing in the services sector, seeing in the manufacturing sector. This says, look, this recovery is rapidly running out of steam. Now let's go into the JOLTS job openings. This is Janet Yellen, former Fed Chair Janet Yellen's favorite data point. We'll go to the Fred data where we can see a bigger picture of it, and we'll zoom it in for you. And what does this tell you? This is the number of job openings. And so the whole idea is, in a growing economy, there will be more job openings than jobs. And it's pretty simple. You say, well, why would that be? Well, I'm in California. Maybe there's a job in New York that I'm qualified for, but I'm not really interested in moving to New York. So it's not like there's got to be a one-to-one job for every seeker and every employer. What it's showing is, hey, employers are looking for people. And what did we see here? We saw obviously the economy shut down, so they weren't looking for employees. They pulled out, they pulled those applications. As employers reopened, they said, yeah, we're going to need to hire some people, so we'll have some job openings, but look at how it rolled over. Now, this is August. It's a very delayed data set, but what it tells you is demand for the labor pool is trending lower, and that's not what you see when you're looking for inflation or an expanding economy. Let's continue down this and see what else we can find. Into the mortgage application data. This is very volatile. It moves a lot. The key here is, and we don't know the answer, is what applications turn into actual agreements, actual contracts. We don't know that information. The oil industry, because of all the storms going through the Gulf Coast, not much to worry about. The 10-year and 30-year auctions this week were great. The market, yeah, you saw after the auctions they sold off, but the auctions themselves were fine. I mean, there's plenty of demand. We're not going to dig into that today. Consumer credit. Now, this is really interesting. In a debt-based economy, you want to see an expansion of consumer credit consistently. So if we open this up and we zoom down and we go to the show more, show more, show more, show a lot more, what do you see? An expansion of credit right here. And then look what happened in March. Contraction of 12 billion. April minus almost 69 billion. And May minus 18 billion. And then we got started getting a recovery in June. Expansion of 9 billion. July expansion of 12. And then August it was supposed to be 14 and it was minus 7. Now this is telling you the economy is rolling over, or started rolling over in August, based on the credit data. Now I pulled up and I had to put the chart together because Fred did not have them all consolidated, so I had to put them together. And look at this. During recessions, you see credit start to head lower, just as I've said. And there was a little blip here in, 2015 that led to a choke in the stock market. And how about a blip right here that's rolling over? Now let's do this. Let's go and run this on a year-over-year rate of change and see what it looks like. And what do you see? During recessions, you tend to get a contraction in credit. Just exactly what I've said. And here it is, a contraction in credit. Now let's go on and overlay 10-year Treasury yields, because what does everybody say? Oh, interest rates can only go up. And as we know, that is not the case. So let's go and overlay 10-year Treasury yields. And we'll zoom back in. And what do we tend to see? When credit contracts, interest rates tend to fall. Now, they can rise in the middle of it, they tend to fall. And look, we see credit contraction. There was that big drop here. I'll zoom in. I know you can't see that. There's that big drop right here. Does that help? So now you can see that lower interest rates, even though the market thought interest rates were going to rise, no, they went lower. How about here? We saw that deflationary shock in late 2008. Markets had higher yields. I think we get a replay of this, and ultimately it led to lower yields because credit was contracting, took a while to get back into place. And here we are now. And as I pointed out in the Wednesday video, the big difference now is we got the Fed doing QE at the long end of the curve, and they're not going to stop doing that. They quit doing the T-bills. They're sticking on notes and bonds. So the odds of a back up in yields in the short term is unlikely. That's more probable that we get lower yields because what is happening? Credit is contracting, just as I said usually happens. Let's go into Thursday. And what do we see here? Initial jobless claims sitting at 840,000. You know, this has been consistently here. So if you're looking for an improvement in the labor market, you would need to see this number going down, down, and down. And it's static. It's holding here. This is not a positive sign. Now, some people will point to continuing jobless claims that are going down. These are state claims that are rolling onto the federal balance sheet. And what we're seeing on total continuing claims is somewhere between 25.5 to 26.5 Americans are still receiving some form of unemployment benefit. Again, we had a nice 30-year auction. I'm not going to look at the Japan data, but I will tell you it was not pretty at all. Okay, so let's move on to the H.8 data, and then we'll get into the PowerPoint stuff and all of that. So what do we have going on in the H.8? Well, we have trolling by the banks. Treasury and agency securities went up by $17 billion week ending September 30th. Now, when is that? Let's go pull up a chart here. We'll use TLT because it's a little easier to make sense of. And that's the week ending September 2nd, which is right here. So right up here. So that means when all this heavy selling was going on right here, these 5 days, so these 2 days here and then these 3 right here, the banks bought $17 billion of U.S. Treasury securities. I'll be interested to see what they bought the coming week because there's more volume here and more price action going on. So we knew, remember we said could this be a final move where the banks were trying to pull everyone out? And at the moment, it says yes. Now, here's something I want you to understand. because there's a lot of confusion. Everyone's still talking about, okay, there's going to be inflation, like bond prices are going down. Now, when you look at this chart, do you think the commercial banks are stupid? No, they are the smart money. When we looked at Wednesday on that data from Jeff, and when you said, who's the dumb money, the speculators, who's the smart money? These people right here, the commercial banks. Now, do you think they're going to lose money on all these bonds? Well, let me tell you how many they own. They own 4.418 trillion, or total in securities, 3.5 trillion of them in treasuries, and 2.3 trillion of them are mortgage-backed. Do you think they really want higher interest rates? Do you think they want to get slaughtered on their $4.4 trillion bond portfolio? No, they don't. Everybody's betting, who's the smart money? Right here, commercial banks. That's who the market's betting. It's them and the Fed. And who is the Fed beholden to? Somebody in the comments said, well, won't the Fed bail out the speculators? No, the Fed doesn't bail out speculators. The Fed bails out banks who are selling all those shorts to the speculators. How about mortgage-backed securities up 18 billion? Remember, I said, why are they dumping these things down? And what were they doing? They were setting up to troll the market. Obviously, they're adding back. So that was a big move for the banks buying back bonds. I bet the number goes up. How about loans and leases at all commercial banks down 24 billion? See, again, credit is back to contraction. Commercial industrial loans down 23 billion. Residential real estate up $1 billion. So despite all those applications, nothing going on there. The best probably news in all this is consumer loans were up, about a little over $3.5 billion. And that's positive for the consumer. Looks like they're charging on their credit card. We'll see how long that story actually will last. Who knows how long that will. I don't think it lasts too much longer with all these loans coming out of deferment. How about the M2? So we see something interesting in the M2, the 12-month rate of change. It shouldn't say rising. I think it actually fell. I always forget to update something on these. And the 6-month rate of change is falling, and the 3-month rate of change actually ticked up. Actually, I thought all of these actually fell because the M2 actually did drop. And we'll look that up. Here it is, the M2. Oh, by the way, I have a big special announcement. Apparently the Bond King might be live this weekend. We'll get to that in a little bit. So looking at the M2, savings deposits went up a little bit, but demand deposits, these are going to be your checkable deposits, they went down. Now, why did I think that was going to happen? Well, because guess what happens at the end and the beginning of every month? People have the most bills to pay. Institutional money funds were down as money, again, goes back into equities. So we'll hold on to that thought because certainly want to come back to the Saturday night party that may be coming. You're going to love this. Monetary base, now we only get monthly updates, so I'm not really sure where it was relative to before, so we're going to start kind of from here, and then we'll adjust the slide. So the monetary base is sitting at 4.807 trillion, and we'll now get our monthly update on the Money Multiplier, which says it went down. So again, if you're looking for inflation, you would want to find it in the Money Multiplier, and the Money Multiplier says no inflation here. In fact, it's rolling over. And isn't that interesting? At the same time the Money Multiplier is starting to roll over, that we already saw the economic data, or we're seeing the economic data start to roll over along with it. Very interesting. How about real estate loan growth? The year over year was up 0.04 to 3.09. 6-month rate of change is pretty much sitting at zero now, and the 3-month rate of change also is now was zero pretty much, and is now negative. Again, no real estate growth, bad for debt-based economies. Commercial industrial loan down 15.6% from a year ago. 3-month rate of change almost at -4. 3-month rate of change at -5 and change, all falling across the board, bringing all loans and leases at all commercial banks. Growth rate is down to 5.66. This is still high on a year-over-year basis, but it's going to come down real quick because the 6-month rate of change is at -2. The 3-month rate of change is at -1.3. That's telling you credit continues to contract. Why are banks buying treasuries and mortgage-backed securities? Because they know this. We did see a little blip in the credit card data, so now we're up to -8.91% from a year ago. Could be the beginning of a trend, may just be a short-term pause here in that data. Who knows for sure? My bet is with all these loans coming out of deferment, that doesn't hold. So with the markets closed on Monday, I doubt there'll be a video. I'll still do the Sunday chart video. I don't know if I'll put it up Sunday or Monday, but I'll still do that. Now, the special announcement that I have for you, let me get that ready, is the Bond King will be live on Mike in the night on Saturday at 8 p.m. Well, apparently, Mike is buying cocktails, appetizers, and has giveaways, or none of the above. And we'll be taking live questions, hopefully none overly too serious, but we'll see how long the Bond King can stay awake because he usually just passes bedtime somewhere around there. So anyways, Mike in the night, 8 p.m. Pacific, 11 p.m. Eastern, and that's where we'll be. I will look forward to seeing you there. If you want to come out and hang out with us, we'd love it. In the meantime, be sure, I'll put a link to that in the description. Be sure to subscribe. I love all of you. Thank you for being fans. Be sure to give us a like, as always, and let's wrap this up with a disclosure that I'm totally unprepared for. But again, look forward to seeing you on Mike at the Night. I'm Steve Van Metre. Bye now. The content of this video is provided as educational information only. Is not intended to provide investor or other advice. Channel is not to be construed as recommendation or solicitation by our security, financial instrument, or to participate in any particular trading strategy. This video is prepared by Steve Van Metre. All person capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steve Van Metre Financial.